Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Strategas Vice Chairman and Chief Economist Don Rissmiller to talk all things markets. Don, how are you doing today?
Very good, Ross. Good to talk with you.
Great to talk to you as well. And I think at a really, opportune time at the end of the year to look forward to 2023 and get your outlook on things. So, with that as the setup, what is your base case for the economy in 2023? And maybe what are some of your highest conviction ideas about the economy heading into the new year?
Yeah, Ross, it's been a tough year for sure, no question. The issue that I see is for however tough 2022 has been, we've not accomplished enough at rebalancing supply and demand to say we've reset the cycle. So the goal of macroeconomic policy always is to get supply and demand to balance. If you don't have that, if you have imbalances, you'll see things like what we've seen over the past year. We have inflation. We have a market that is struggling to clear. And so we need to see a flush, and we just have not seen that, especially in the labor market. And so if the labor market in the U.S. is still overheating, and that's our base case, then one of our high conviction ideas has to be that if supply will not come up to meet demand, demand has to come down to meet supply. And that's what the Fed is trying to accomplish with interest rate increases, with their balance sheet policy. But that's still ahead of us. And a way of saying demand comes down is saying there's a risk of recession. So unfortunately, perhaps as we look to next year, we have to believe risks continue to skew to the downside until we get the economy into better balance.
That makes a ton of sense. And I think on a lot of fronts, we're seeing improvement in the inflation picture. You look at things like commodities, supply chains, those have started to normalize. Even housing prices and rental indices have started to come down. The big issue, as you mentioned, and it's the big issue that Fed Chair Powell has talked about, is the labor market. What are you seeing on that front? It seems that there's just a structural shortage of workers in the economy. How does this rectify itself? What's your outlook for the labor market?
Sure, and this is very important for the inflation picture. So we're seeing some things, as you mentioned, that are getting better, especially on the good side of the economy. But the U.S. Has a heavy weight in services, and what matters for services is the wage profile and what goes on in the labor market. And as we said, the labor market still looks very tight. There's over 10 million job openings for 6 million unemployed people right now. So that type of overheating is not a stable position. And so it's a situation where we're adding jobs, if we look at the payroll survey, but that's not what we want to see at this moment. We actually want to see some slack start to develop because that will get the Fed to relax. Until the Fed is comfortable, we cannot say that we've eliminated the risk. And that's our concern going forward.
That makes a lot of sense. So I think, if there's one thing to watch in the new year, the labor market would make sense as an indicator for both inflation and for how the Fed will respond with rate hikes or pausing or even easing later in the year. So your all's base case, slowing economy, potential recession, profits at companies need to fall. There's a lot of pressure on companies on the cost side, and that pressures profit margins. One way to counter that is for the people that are employed to be more productive. And we've really seen a stalling out and kind of disappointing productivity numbers. And we just got a revised productivity number in this last week. I wondered if you could talk about what you think is happening there and why you think productivity hasn't been a tailwind for the economy. Is it something that could be a tailwind going forward?
So that's right. We've had a tough year on productivity. We actually saw quite negative numbers in the first half of 2022. This is the pathway forward. We have to get productivity back up. And the U.S. economy has done a good job over time at getting productivity up. But the pathway from here to there, the way we get productivity up, is probably through a reallocation of existing labor and capital. And what that means is we'll probably see some job loss in the meantime. So we have the answer. We know productivity will reaccelerate. That's really how you get out of a downturn. You do a better job at allocating existing resources. But the pathway between where we are and where we need to be is that adjustment. And so that job loss, as we see productivity start to recover, is what we have to digest.
Absolutely. So let's end here with your outlook for 2023. You all have a probability odds of recession, soft landing, and actually an upside surprise. Could you break those down for us as you see 2023?
Sure. Yeah. So the economy probably is not in recession right now. If we look at capital spending numbers like durable goods orders, if we look at the payroll employment number, it's not negative yet. But there's an elevated risk of recession, and it's probably a 50% odds of recession over the next year and a 75% chance of recession over the next 2 years. And the reason is basically tied back to the Fed. We cannot remove that downside risk until the Fed declares victory. They have to say mission accomplished, and that will mean inflation comes down and stays down. Inflation will roll over if we have a recession. Even in the 1970s, that was true. It has to come down and stay down for them to be satisfied that we're not executing the stop and go policy that we saw in the 1970s. And that takes time. So while we're not in recession right now, the risk has to stay elevated probably for 2 years until we can make a different statement on the balance.
That makes a lot of sense. We appreciate the insight as always. And Don, thanks again. Hope to talk to you soon in the new year.
Thanks, Ross.